Analyst, SYNNEX just completely detonated an earnings report that is ruthlessly stress testing literally everything the market thought it knew about cautious enterprise IT growth narratives right now. I mean, think about it. We are in a macroeconomic environment that is absolutely terrified of enterprise IT spending pullbacks. We hear constantly that corporate CIOs are freezing budgets, cutting costs, delaying upgrades. But then this report drops, and it is a massive structural outlier. We are talking about a foundational, reinforced concrete EPS beat that forces us to entirely reevaluate the architecture of tech distribution in the AI era. It's a true heavy-hitter moment. Okay, but before we go crowning them the undeniable king of enterprise tech logistics, we really have to look under the hood. Because, honestly, the cash flow statements are flashing some extremely serious warning signs. You can't just build a skyscraper on a cracked foundation. Welcome to Iron Financial, everybody. If you are here to forge a stronger portfolio, to cut through the market weakness, and to demand real, unfiltered answers from complex financial statements, well, you've found the right crew. Make sure you hit that subscribe button right now so you never miss an explainer. Absolutely. Today, we are conducting an exhaustive, line-by-line structural autopsy of SYNNEX's fiscal second quarter 2026 earnings report. We are going to take our hard hats, get down in the dirt, and rip this scaffolding completely apart.
All right, let's dive straight into this. If you just look at the surface level, we are looking at pure, unadulterated fundamental strength, a 62.2% non-gaap earnings per share surge. The headlines are absolutely ecstatic this morning. The algorithmic trading bots are buying the news, and the overall bull case is being built on this incredibly solid foundation of profitability growth. Hold on, let me just stop you right there. Let's not get blinded by the flashy headlines, all right? I am immediately going to interrupt this victory lap you're taking because we have a frankly terrifying reality staring us right in the face. Plunging free cash flow. We are looking at negative $332.4 million in free cash flow for the quarter. Let me ask you this. How does a company post a massive 62% surge in earnings while simultaneously burning a massive hole right through their balance sheet? That right there is the central tension of today's explainer. We have to figure out, is this earnings beat actually real, or is this heavy machinery just burning through stockpiles of cash merely to keep the warehouse lights on? Well, that is exactly what we are going to find out today. Here is our structural inspection checklist. First, we'll examine the headline blueprint. Second, we're going to isolate the load-bearing growth drivers. Third, we'll interrogate the margin squeeze paradox. Fourth, we dive into your absolute favorite topic, the cash flow trap. Fifth, we analyze capital allocation and guidance. And finally, we will deliver our iron verdict. Let's get to work.
Section 1. The headline blueprint. Let's look at the top-level schematics. Transitioning into the first phase of our inspection, we absolutely have to analyze the foundational revenue and earnings numbers from this FQ2 2026 report. Like I said, these are the top-level schematics that the entire market is trading on at this very moment. And honestly, the top line is staggering. $19.57 billion in quarterly revenue. That is a 31.0% GAAP revenue explosion compared to the $14.95 billion they posted back in Q2 of 2025. Just let that sink in for a second. In the gritty world of commercial distribution and enterprise technology, adding nearly $5 billion in incremental quarterly revenue year over year, that requires an incredibly resilient industrial-grade operational architecture. We aren't just talking about software licenses being emailed out with zero marginal cost. No, we are talking about physical servers. We are talking about massive data center racks, heavy metal moving through incredibly complex global supply chains, requiring vast warehouse space, massive freight logistics, and intense capital allocation. This number proves that despite all the macro headwinds, the sheer physical volume of technology moving through SYNNEX's pipelines is expanding at a fiercely aggressive rate. It's a massive number, I'll give you that. You can't fake nearly $20 billion in top-line revenue. But moving volume isn't the same as moving profitable volume. Anyone can move $19.5 billion of physical product if they just discounted it enough to get it off the loading dock. I want to see if this blueprint actually matches the financial reality on the ground, or if it's just a glossy rendering designed to keep the shareholders complacent. What does the actual bottom line look like?
Oh, the bottom line is arguably even stronger. Here is your answer, and it is a reinforced concrete pillar of profitability. $4.85 in non-gaap diluted EPS, that is a 62.2% surge from the $2.99 they reported a year ago. And you know what else? It utterly destroyed the consensus estimates, which were sitting way down at $4.14. Wall Street analysts thought this structure would yield 4.14. They weren't even in the same zip code. They built their little models in cautious, conservative spreadsheets, completely missing the industrial reality of TD SYNNEX's operational leverage. You asked if they are just moving discounted volume? Absolutely not. The EPS growth completely outpaced the revenue gains. Think about the math. Earnings are up 62% on revenue that is only up 31%. That tells me this underlying business is incredibly, ruthlessly efficient at converting top-line expansion into bottom-line shareholder value.
Section 2. Load-bearing growth drivers. Let's see what's actually holding up the roof.
All right, the headline numbers are undeniably strong. I can't sit here and logically deny a 62% EPS beat. But let's shift our focus to the structural, load-bearing pillars of this business. As we mentioned, the broader enterprise IT market hasn't exactly been on fire lately. So where is this $19.57 billion actually coming from? Are specific high-flying, low-margin segments masking broader traditional weaknesses in their core distribution architecture? Let's break down these segments.
Well, if you look at the raw tonnage, the heavy lifting is still very much being done by their traditional distribution segment, which hauled in a massive $23.42 billion in non-gaap gross billings. That is your solid, steady bedrock right there. But the explosive momentum, the secular tailwind that is completely re-rating this stock in real time is Hyve Solutions. Hyve billings skyrocketed an unbelievable 117% year-over-year to $5.46 billion. For context, Hyve is their custom cloud and AI infrastructure business. What you are seeing here is the secular AI demand translating directly into hard industrial scale revenue.
Yes, Hyve is exploding, no argument there. But let's not ignore the structural weight of that traditional distribution business. $23.42 billion in gross billings is the 800-pound gorilla in the room. If traditional IT hardware distribution slows down even a little bit, Hyve's 117% growth won't be enough to hold up the entire building. The distribution segment is the core foundation, and the margin differences between moving standard Office PCs versus building custom hyperscale servers are vastly different. If the traditional hardware segment weakens, the entire load-bearing capacity of this company is seriously compromised.
But the foundation is holding, and we can see it clearly through distinct product-level dynamics. We have steady 13% growth in endpoint solutions. That's your standard PCs, mobile devices, peripherals, hitting $9.9 billion. That completely proves the PC refresh cycle is stabilizing and carrying its own weight in the structure. Meanwhile, advanced solutions, which includes your heavier enterprise tech like servers, storage, networking, and software, saw a massive 31% surge. That is underpinning a $13.5 billion gross billings print. Both pillars are holding strong. Look, I see the 31% surge in advanced solutions, but my job is to look for cracks in the armor. Endpoint solutions growing at 13% is fine, but it's historically a lower margin, high volume game. The real structural question is this. As advanced solutions and Hyve become much larger percentages of the overall structural load, what is happening to the margin profile? Are they sacrificing their pricing power just to win these massive high-profile AI server contracts? Which brings us to Section 3, the margin squeeze paradox. This transitions us perfectly into the next phase of the inspection. We are going to hunt for those cracks in the architecture by focusing intensely on the structural tension between operating margins and gross margins. This is what we call the margin squeeze paradox.
And here is the exact paradox I was warning you about.
Yes, you bulls are going to enthusiastically point out that GAAP operating margins expanded by 45 basis points to 2.65%. That looks phenomenal on a headline. It suggests great operational efficiency. But you have to drill down into the gross margins. Gross margin actually compressed by 16 basis points year over year, falling down to 6.84%. To me, this is a clear structural deterioration. Volume growth is completely masking a loss of pricing power. Yes, they are moving more metal, but they are making less money on each individual box before the operational costs are even factored in. Come on, you are completely missing the forest for the trees here. Operating margin expanded. Do you know what that means? That means their internal scaffolding, their cost controls, their operational leverage is so incredibly robust that even with a slight 16 basis point compression in gross margin, they are still dropping more money to the bottom line. How do you pull that off? You do it through aggressive SG&A leverage. You keep your internal headcount flat, you aggressively automate your back-office logistics, and you squeeze absolutely every single ounce of efficiency out of your existing warehouses. So even though the raw materials are yielding slightly less gross profit per unit, the final machine drops actual tangible dollars to the bottom line. That is exactly how world-class distribution models are built to scale.
Okay, but drill down specifically into Hyve Solutions for a second. In Q2 of last year, Hyve's gross profit percentage was 4.75%. In this recent quarter, it plunged to 3.68%. That is a massive, significant drop in profitability for what is supposed to be their fastest-growing crown jewel segment. Explosive volume growth is completely masking a structural deterioration in pricing power here. It makes me wonder, are they just buying market share in the AI data center buildout? If Hyve becomes a larger and larger part of the overall revenue mix, but its margins keep collapsing like this whole earnings facade is going to cave in on itself.
Let's move to Section 4, the cash flow trap.
Okay, I hear you. You've made your point on margins, but the operating income still printed record numbers. However, we are now entering the absolute most critical point of friction for this explainer, the cash flow trap. We need to expose the severe working capital leaks that you've been screaming about since the top of the show. So, have at it. I am dropping the hammer right here. Negative $332.4 million. Despite reporting these so-called record profits and a massive EPS beat, free cash flow plunged to negative $332.4 million. This is a catastrophic reversal from the incredibly positive $542.9 million bedrock we saw in Q2 of 2025. We are talking about a nearly $900 million swing into the red in free cash flow. You cannot pay dividends with non-GAAP EPS. Let me repeat that because it is the fundamental law of financial gravity. You cannot pay dividends with non-GAAP EPS. Non-GAAP earnings are an accounting fiction. They are a stylized rendering of reality that strips out stock-based compensation and amortization to make the architectural rendering look pretty for the investors. But guess what? You cannot buy back stock with a rendering. You cannot pay your massive suppliers with gross billings. You need cold, hard cash flow. And right now, the cash is actively, rapidly draining out of the foundation of this company.
All right, let's be fair for a second. In commercial logistics and distribution, massive working capital fluctuations are simply part of the normal business cycle. But I will admit, looking at the operating cash line is striking. Net cash used in operating activities was negative $265.6 million.
Market skeptic, striking, try terrifying. This heavy machinery is literally burning cash just to keep the lights on and to fund this massive AI growth narrative. The cash conversion cycle is clearly under severe stress here. If your operations are sucking away $265 million in cash in a single quarter during a massive IT boom, what happens if enterprise spending actually decelerates? I'll tell you what happens. The whole structure freezes up entirely.
And let's look at exactly why the cash is gone. The balance sheet is currently buckling under a terrifying structural load. Inventory has ballooned to an eye-watering $13.89 billion. That is up from just $9.50 billion at fiscal year-end 2025. We are talking about a multi-billion-dollar inventory buildup in just 6 months. Plus, they have another $12.99 billion sitting tied up in accounts receivable.
Look, you have to understand the underlying mechanics of the Hyve business. AI servers and hyperscale infrastructure require massive upfront capital outlays for components. You can't just spawn a server rack out of thin air. They are purposefully building this inventory to meet committed, contracted demand from massive hyperscalers. It's simply a timing issue between buying the parts and getting paid for the final build.
A $13.89 billion timing issue? Give me a break. That is working capital stress of the highest order. Do you realize the physical weight of that much inventory? And let's dive into the sheer risk of obsolete AI inventory for a second. In this current AI arms race, technological decay happens at light speed. A 6-month-old server component isn't just old inventory, it rapidly becomes a highly expensive, completely useless paperweight. If even a fraction of that inventory becomes obsolete, or if a major hyperscaler decides to delay a project by even 1 quarter, that massive inventory pile becomes a deadweight anchor pulling down the entire balance sheet. This right here is the hidden structural cost of the enterprise AI growth narrative that nobody wants to talk about.
Section 5, Capital Allocation and Guidance. Let's look at the forward plan.
Let's attempt to stabilize the narrative here for a second. Management is acutely aware of the working capital dynamics we just discussed, but let's look at their blueprint for the future and their current commitment to shareholder returns. Actions speak far louder than temporary timing mismatches on the cash flow statement, and their actions are heavily pro-shareholder. They literally returned $151 million to stockholders in this quarter alone. That breaks down to $112 million in stock buybacks and $39 million in dividends. Furthermore, they just declared a 48-cent quarterly dividend, which is a 9% increase year over year. Think about the psychology here. Management would absolutely not be aggressively repurchasing their own shares and hiking the dividend by 9% if they genuinely believed the working capital stress was some sort of terminal structural flaw. They are doing this because they inherently believe they are building on solid bedrock.
Okay, but let's look at the Q3 2026 guidance before we just blindly trust management's confidence. They are guiding for a revenue outlook of $18.2 to $19.0 billion and a non-GAAP EPS of 4.25 to 4.75.
Which, by the way, is well above previous consensus estimates.
Yes, it beats consensus, but look closer. It is sequentially lower than what they just printed. They just did $19.57 billion in revenue and 4.85 in EPS.
The high end of their own guidance for next quarter implies a sequential slowdown in both top-line revenue and bottom-line earnings. Are they quietly bracing for a structural slowdown while projecting confidence through a shiny new dividend hike? Because if growth is truly decelerating sequentially, that $13.89 billion inventory pile we just talked about becomes incredibly, incredibly dangerous.
Section 6, the iron verdict. It's time to make a call.
All right, all the data's on the table. We have massive top-line expansion and incredible earnings leverage, fighting directly against severe working capital constraints and very real gross margin compression. It is time for us to converge and deliver our final, definitive conclusion on TD SYNNEX's viability in a high-stakes portfolio. It is time for the iron verdict. So, is this a steel-reinforced opportunity fueled by secular AI demand? Look, I say yes. The 117% Hyve momentum is undeniably real. The 45 basis point expansion in operating margins definitively proves the structural efficiency of this business model. I firmly argue that the inventory build is just temporary friction. It's the raw materials necessary to construct the AI infrastructure of tomorrow. Market skeptic. Or is it a cash-burning value trap waiting to collapse under its own weight? I argue that negative $322 million in free cash flow simply cannot be ignored. A $13.8 billion inventory load is a massive, towering structural risk. If Hyve's gross margins keep compressing down into the 3% range, they are essentially doing incredibly heavy lifting for free. The iron verdict from my side is this: tread with extreme caution. The earnings headlines might be made of steel, but the cash flow beneath it is made of paper.
Which ultimately brings us to the most important question for you, the viewer. Is your portfolio built to withstand this kind of structural cash burn in the pursuit of enterprise AI growth? TD SYNNEX is moving the heaviest machinery in the entire tech sector right now, but the true cost of that exponential growth is immense working capital stress. You have to decide if you are buying the flashy EPS headline or if you are properly pricing in the cash flow trap hidden in the basement. Thank you so much for joining us for this structural autopsy. Keep demanding real answers, keep interrogating those financial statements, and we will see you on the very next explainer right here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.